Earlier this week, the Investment Company Institute proposed its own plan to backstop money market funds in the event of another crisis. ICI is rejecting alternative solutions considered by regulators. Instead, it's calling for fund companies to finance a private bank with $350 million in assets that would grow to $24 billion in 10 years. Schott Stevens is the president and CEO of ICI. He joins us now from our Washington newsroom with more. Mr. Stevens, welcome to Bloomberg's Bottom Line.
Thank you.
Sir, let's start by discussing the role of money market funds in the overall economy. We are talking a nearly $3 trillion investment here, right?
That's correct. And it's one that serves many, many thousands of investors, both institutions as well as retail investors, and provides an essential source of funding to American companies, to state and local governments, to the banking system, for that matter, even to the United States Treasury. They are a very fundamental and consequential part of our economy.
Well, after the Reserve Primary Fund collapsed in 2008, repayment to clients was delayed because of losses suffered when Lehman Brothers declared bankruptcy. The SEC has implemented new rules for money market funds. They were implemented last year. And for the most part, the industry did agree with those changes, but there are still some areas of disagreement going on. Whether to have a floating net asset value is just one area where you don't see eye to eye. Those issues will probably be decided this year. You have concerns that regulators might adopt something that makes money funds less profitable for your members and maybe less attractive for their customers.
We actually think that the process of considering additional reforms has been a good one. The SEC rules that you mentioned have assured that money funds now have daily and weekly liquidity levels that would assure a much greater ability to meet even the large cascade of shareholder redemptions. There is a search for additional ways of making these funds resilient even in the worst market circumstances. Some good ideas have been advanced, like a liquidity facility, for example. Some bad ideas have been advanced, like forcing these funds no longer to have a stable $1 per share value. That's such an essential feature of money funds today that we fear that if you take that away, you simply would not have the base of investors. They would either move to unregulated products and replicate whatever the risk is there, or simply would be denied the benefit of money funds altogether.
Mr. Stevens, the liquidity facility would have access to the Fed's discount window. Prime money funds hold about $1.6 trillion, and fund companies, as we mentioned, will put up about $350 million to get the facility started. Why shouldn't these companies have to put up more of their own money and not fund money if their products are going to enjoy the protection that Fed access brings?
Well, understand the Fed access is a feature of this because the facility would be organized as a commercial bank. But the core intent is to make sure that the bank has a capacity that would add an important liquidity buffer of its own. It would do so at the expense of fund sponsors. It would also do so at the expense of funds and their shareholders. But after all, it's funds and their shareholders who would enjoy the benefit of this liquidity were it ever required.
You are proposing also that participation in the liquidity facility be mandatory for prime funds. Fidelity, the largest money fund provider, and BlackRock, the world's largest overall money manager, they're against this plan. How's this going to go forward without their support?
Well, this has been a complex challenge, as I think you understand. Lots of ideas have been advanced. The fact is it's not unanimous within the industry that this is the most promising way to address the issue of money funds that remains after the SEC's rules.
Right.
But I would say that it has substantial support within the industry, and I would also predict that if regulators say a liquidity facility is the right way to go, that it would have unanimous industry backing.
Well, Mr. Stevens, Scott Goble, the general counsel for Fidelity, wrote, quoting here, "We have concerns that the cost, infrastructure, and complications associated with private liquidity facilities are not worth the minimal liquidity that would be provided."
Well, with all due respect, I think over time there would be substantially greater facility when the economics of money funds changes. The yield to investors is greater than it is today. As you know, it's razor thin at the moment. The facility could be ramped up in terms of its capacity much more quickly. But that's the judgment of one fund provider, an important one, no doubt. Many others that are major factors in the business have an entirely different point of view. I would say the consensus within money fund providers is that the liquidity facility is the most promising policy option identified thus far.
Is the size of the facility going to be an issue? No doubt government regulators want it to be large. The mutual fund industry will want it to be smaller.
Well, I wouldn't say we want it to be small. We want it to be adequate. But we have to be realistic. We're inventing a new kind of tool, a new institution. It's not going to spring fully armed on day one. It'll have to have some time to grow, and regulators will have to exercise some forbearance. But we believe that over a period of time, it could have substantial capacity as the economics of the business change and its capacity were to grow beyond the 3 basis points contribution by funds that we've been modeling. And that's simply as a result of their current razor-thin yields.
Mr. Stevens, in our last minute, what are the most serious risks to money funds?
The risks that money funds managed and have managed historically very effectively of interest rate risk and credit risk are always on the table. What the financial crisis indicated is that there's also a liquidity risk that we must address. The SEC rules have gone a long way in that direction, and frankly, we believe the liquidity facility is an idea that will additionally help to address that risk as well.
Paul Schott Stevens, President and CEO of the Investment Company Institute. Mr. Stevens joining us from Washington. Thank you so much. We appreciate your time.